Welcome back. Well, we're putting the spotlight on and the numbers are looking very, very interesting. This might just be quite a landmark year for the media sector in the company. And here is why. According to an EY FICCI report, digital continues to reduce the gap with TV. And in fact, digital is going to overtake becoming the largest media segment in 2024 at close to 76,000 crores in revenue. Not just that, advertising revenue for the year 2023, for TV ad revenue, that is, was down about 6.5%, and it continues to face competition from various aspects like social media, gaming, short videos, and a lot more. To talk about these trends and what they mean for listed companies, of course, the sector as a whole, we have with us Karan Taurani of Elara Capital and Ashish Ferwani, partner, media and entertainment, and a business consultant at EY. Gentlemen, thank you very much for joining in. Ashish, let me open out with you, and that's quite a telling figure, right? Digital finally becoming so large that it'll overtake TV. And in terms of just the number of hours spent on consuming content, I think we were far ahead of the US and only second to China, right, here in India?
That's correct. I think it's the combination of the often heard factors that you have inexpensive data and you have a huge bit of a digital infra being set out, whether it's 550 million smartphones or 38 million wired households in terms of broadband. I think the massive investments that India has been making over the past 7 to 10 years in these areas, I think that's really what's caused this big change.
Okay. So the question, let me open this up and bring Karan in as well. Karan, the question is, what next and how do we marry everything that we're seeing? Because we've also seen these mega deals in the media landscape. The Disney Hotstar Reliance combination, where actually valuations have come down. We know that deal happened at valuations which are far lower than what was initially being sort of forecast. So, tie this up for us, the rise of digital, the fall in TV ad revenue, and this consolidation that we're seeing in the sector.
So, Surabhi, the problem for the media industry in India is that, everything is moving to digital in terms of consumption. And somewhere, linear TV companies are not able to scale up their offering on digital in terms of whatever content they have to offer. They're not able to grow beyond a certain scale. And that is a struggle. The struggle is because of two reasons. One is, sports takes away a lion's share as far as media content consumption is concerned, and that's expensive in nature. So not all companies are able to invest into sports. And second thing is the digital landscape or the digital advertising market rather is quite fragmented. On the linear TV side, you are competing with TV players. On the digital side, you're competing with e-commerce, social search. These are big giants here. So I think that's been the problem here. And I think that's the reason why we're seeing consolidation. So this entire, the deal of, Disney, Viacom is taking place is primarily because of this reason where they want to bundle TV and digital as an offering. And they really want to scale up, their digital monetization revenue for the content that they have.
Gentlemen, good morning. Ashish, if I can come to you. In your opinion, the same kind of question on the same lines, really. When you advise companies, what is the sort of optimal or the right kind of portfolio that a media and entertainment company should have as they move forward in this kind of sort of fast-changing landscape, which, of course, directionally is moving towards digital, everything. Go on.
So I think if you just take a step back and see where's this industry heading, right? So this year, what we've tried to do, even in the report, is to estimate how the situation will be in 2030. By then, we'll have almost 1 billion screens that are active in this country, right? Out of which about 3/4 will be mobile phones and 1/4 will be large screens. So any company today definitely has to have a strategy that straddles both the small screen and the large screen. On the small screen, consumption is extremely different from the large screen. So do you have enough in terms of online gaming? Do you have enough attraction in terms of short video? Do you have enough traction in terms of influencer marketing? I think these are some of the key things that are going to drive consumption on the smaller screen. On the larger screen, again, a very interesting change is actually coming about. We are seeing 3 large segments forming by 2030. You'll have about 80 to 85 million pay TV homes. You'll have 57 to 60 million free TV homes. And you'll have over 70 million connected TV homes. So again, anything that a company who wants to stay relevant in media needs to achieve, it has to have a strategy that straddles all the pay TV, the free TV, and the connected TV markets. And I think that's something that has come out very strongly over the last 1 or 2 years in terms of directionally where the industry is heading. You have to have a multimedia, multi-format, and multi-screen size strategy.
Just a couple of sort of follow-up questions, Ashish. Small and large, you mean mobile phones and television screens, right? That's what you meant.
That is correct. Small screens would be your mobile phones and phablets. Large screens would be connected TVs or linear TV.
Sure. Sorry, and that other point, so free, connected, and
Pay TV.
sort of pay. What is the difference? What's connected TV in that category?
Connected TV is a large screen that's connected to the internet, runs on broadband, right?
Okay.
Free TV is, of course, what we call free dish in this country, run by Doordarshan. Just need to buy a set-top box and get about 180 channels for free. And pay TV is the Hathaways and the Dens and the City Cables, all of them, where you have a linear connection coming into the home.
Okay, all right.
Gentlemen, what does all this mean at the end of the day for companies that are operating in the sector in terms of money making? The big guys are having to spend, they're having to spend on acquisitions, they're having to spend on higher content costs. As Karan said, a lot of that is sports content. So the big guys are anyway spending a lot and they're still burning. The small guys are trying to figure out what to do, whether it's best to be bought out or how do you survive in this, this high cost and highly competitive world. So both of you, come in on this. Who are the winners and the losers, and who ends up making money? Karan?
So obviously, the game is going to, move towards consolidation. It's a winner takes it all market, as we have seen on digital side as well. If you look at the overall India OTT market, Jio Cinema, Hotstar, Netflix, the larger platforms would have, more than a 2/3 of a market, in terms of market share. On the linear TV as well, once this RIL deal happens, if at all, after the approvals going through, you will see them probably having a market share of more than about 40 to 45% on the advertising side. So definitely it's a winner takes it all market. But I think, there is some respite for other players as well. I think that's the good news. Because clearly there are certain segments, on the linear TV side, which are growing at a faster pace, and that's the regional genre. And I think, companies like, Sun TV are entirely regional based. CTV has got a large presence on regional genre side. And thankfully, regional is not very big on digital for now. So if these companies are able to innovate, these companies are able to pull out more original content on the OTT side or digital side, there could be some respite for these companies, and they could also coexist with the larger players because of their presence in the regional genre.
So maybe the regional guys perhaps, have something to smile about. Ashish, same question to you. Who survives, and what about, profits and margins? In general, what are you seeing on ad spends, the ways companies are now, sort of dividing up their budgets? And what can one expect in terms of profitability for media companies?
So I think at an overall level, ad spends, I don't see as an issue. We're still just 0.33% of the GDP right now. So there's a lot of headroom to grow. And when you compare our market to the other developed markets, I think we can easily double that percentage, over the next few years. So I'm not worried about the advertising side. I think where the industry needs to really innovate in order to get profitable is really the cost of customer acquisition and content on one side, and the monetization models on the other side. I think we've seen a situation in television where, the cost of content has been kept so frugal for the last 3 decades. But we're seeing that completely change on the digital side. And I think some level of rationalization is required over there on the content cost from an OTT point of view. But I think more importantly, how do you monetize on digital versus television is a really, really interesting place right now. Are we looking at more TVOD or transaction-led models coming up? Definitely. Are we looking at more subscription products? Again, definitely, and at various price points. But I think the single Brahmastra, if I may use that term, that will really take the industry from a monetization perspective up, will be bundling. I think the way that we've seen, cable companies and DTH companies bundle content from different studios and provide them on television, I think we should see a lot more of that happening over the next 3 to 4 years in the digital side. And once that bundling comes into play at different price points, different products, I think the opportunity to monetize will really take off.
So what does that mean for, net, what does that mean for margins and profitability near future, next 1-2 years for media companies, Ashish?
I think margins will be slightly stretched in the near future because of certain content investments that have been made in the past. I think everyone's realizing that a consumer is pretty content, watching TV content even on OTT. And why do you need to spend 10x more? So, as the content and the customer acquisition sides rationalize, as bundling comes into play, the margins should improve in the medium term. I think there'll be a bit of a stretch for about a year or two right now.
And when you said rationalize on the OTT side, right? Obviously,
On
the
the
TV
OTT
content
side.
of you used to call it frugal. Maybe absolutely right.
Yeah, the OTT side, I think, has been spending a lot of money on content, and rightfully
Yeah.
so. It's in an experimentation stage, it's in a customer acquisition stage. But I think now we've gained scale. We've got almost 45 million homes paying for content. We've got a few 100 million people consuming content online. 500, 600 million is the kind of reach you see here on sports digital. So if that's the case, I think now's the time to get the monetization models active.
No, absolutely. Karan, so just to sort of wrap this up, what are your from a listed perspective, top ideas here in the space?
So I think top ideas in this space are PVR and Sun TV. Z, in terms of the downside, we don't see too much of a downside now. We have a target price of 180. But the problem with Z is that we await some kind of clarity in terms of how a strategic partner or how a financial partner would come in, because that would drive better valuation multiples. That's one trigger. The second multiple would be in terms of the numbers performance. I think if you look at the growth rates, the profitability, it's been quite squeezed over the last 2 years because of environment and because of internal issues and the Z-Sony merger which was there. So I think these two things are multiples. And apart from this, I think Sun TV, is a good regional play. They don't have too much of investments on the OTT side, in terms of other platforms, how they make losses. They're a good business with 60% plus EBITDA margin. And I think, as I said, regional TV might have some respite. So Sun TV is one play. And third, of course, is PVR, because tactically we believe that CY25, next year could be very strong for content because of Hollywood and Hindi genre.
Okay, all right. But you're saying tactically, I mean, that's structure, or it's you got to sort of trade this smartly when you talk about PVR Inox, or is there a sort of structural kind of case you can build here as well?
Not a structural case as of now, because currently, no matter what, on a consistent basis, we are not able to move beyond 80% of pre-COVID levels as far as occupancy is concerned. So it's more of a tactical trade because valuations have come off. Largely, most of the negatives have been factored in. CY24 will not be a good year because of the Hollywood Writers Association strike, which led to a delay in Hollywood content, and even Hindi content is kind of subdued this year. So next year, we are hoping that there'll be better visibility for English content because there'll be a big backlog of English releases that will come, and plus Hindi content will see some improvement post October onwards. So it's more of a tactical trade for now. Structurally, I think we'll become positive on the stock once occupancies move closer to 100% of pre-COVID on a consistent basis.
All right. We'll leave it there. Karan, good speaking with you. Ashish, great conversation, and hope to see both of you back again for more. But it's an evolving landscape which we will need to continue to track as we go along.